Today we're doing a complete breakdown of Indian Accounting Standard 16. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before Indian Accounting Standard 16, companies had wildly inconsistent reporting of property, plant, and equipment. Imagine two firms owning identical $10 million machinery, yet showing different values on their balance sheets. Indian Accounting Standard 16 standardized this, ensuring assets like these are measured and reported consistently. Understanding this standard will help you grasp how fixed assets impact financial health. Indian Accounting Standard 16 emerged to address inconsistent asset accounting. It ensures property, plant, and equipment are measured consistently, improving comparability across companies. Before this, firms used different methods, causing confusion. Now, all companies recognize these assets at cost. This uniformity boosts transparency, making financial statements more reliable for investors and stakeholders who need an accurate picture of a company's asset value. Indian Accounting Standard 16 is mandatory for all entities reporting under Indian Accounting Standard, effective from April 1, 2016. This is vital for firms with large fixed asset portfolios. The standard requires initial asset recognition at cost, including installation or delivery costs. By standardizing this, companies provide clearer insights into asset values, aiding investors and analysts in assessing corporate health and operational efficiency. The cost model is central to Indian Accounting Standard 16. It mandates that assets be recorded at cost minus any depreciation or impairment losses. This keeps valuations grounded, preventing overvaluation and ensuring reliability. Unlike revaluation models, the cost model doesn't adjust for market value changes. Instead, it focuses on accurate depreciation, reflecting the asset's true useful life. Knowing this is crucial for interviews, showcasing your understanding of asset valuation nuances. Scope matters because knowing what Indian Accounting Standard 16 covers can make or break your understanding. Many forget that biological assets are excluded, which is a classic interview trap. Knowing these nuances ensures you don't misapply the standard in practice, impacting financial reporting accuracy. This standard applies to tangible assets that are used actively in the business. Machinery used in manufacturing or computers in an IT firm falls squarely under Indian Accounting Standard 16. It also covers assets still under construction, like a new factory. This matters because depreciation and impairment rules directly affect these assets, impacting financial statements. Indian Accounting Standard 16 explicitly excludes investment properties and biological assets, leading to potential misinterpretations during interviews. Such assets are managed by their respective standards, Indian Accounting Standard 40 and others. This ensures proper categorization and treatment in financial reporting. For instance, land held for investment is not subject to Indian Accounting Standard 16 depreciation rules, unlike operational assets. An asset under Indian Accounting Standard 16 is anything that an entity controls and can expect future economic benefits from. Imagine a delivery truck owned by a logistics company. It's controlled by the company and generates revenue, making it an asset. Recognizing such assets accurately is critical, as they affect balance sheets and profitability assessments. Depreciation in Indian Accounting Standard 16 involves spreading an asset's cost over its useful life, impacting financial performance. Take a $100,000 machine with a 10-year life. It depreciates by $10,000 annually. This allocation affects profit margins and asset valuation, crucial for financial planning. Understanding depreciation ensures accurate reflection of an asset's diminishing value over time, critical for stakeholders. Understanding scope edge cases is crucial for applying Indian Accounting Standard 16 correctly. A leased asset used for production isn't covered, it's under leasing standards. A temporarily idle factory remains within scope, but leased land improvements depend on lease terms. Meanwhile, a company-owned parking lot typically falls under this standard. Recognizing these scenarios helps avoid misclassification in financial reports. Imagine buying a $5 million machine for your factory. Indian Accounting Standard 16 ensures you account for its value, from purchase to depreciation, so financial statements reflect real asset worth. By understanding the cost model, businesses can make informed investment decisions, ensuring transparency and accuracy in their financial reporting. The cost model is the backbone of asset valuation, ensuring cost allocation across the asset's useful life. Meridian Corporation's $10 million SaaS contract with Acme Incorporated sets the stage. With $8 million for the software license and $2 million for implementation, we'll explore how each step of the cost model ensures this investment is accurately reflected in financial statements, from initial cost to potential impairments. Determining the cost of an asset involves aggregating all directly attributable costs. Meridian Corporation's $10 million SaaS contract consists of $8 million for the software license and $2 million for implementation, forming the asset's basis. A common pitfall is neglecting indirect costs, which can skew asset valuation. Indian accounting standard mandates including all direct costs for a precise starting point. Our journey with Meridian Corporation begins here, with a total asset cost of $10 million. Allocating the asset's cost involves spreading it over its useful life. For Meridian Corporation's $10 million SaaS asset, this means distributing the cost across its 3-year term. Misjudging useful life can skew depreciation, impacting financial ratios. Indian accounting standard ensures that cost allocation reflects actual usage, promoting accuracy. With Meridian Corporation, we now allocate $3.33 million annually, setting the stage for consistent depreciation entries. Assessing residual value estimates what the asset will be worth post-useful life. For Meridian Corporation's SaaS asset, consider any resale potential or cost savings after the 3-year term. Failing to recognize potential residual value can misrepresent future benefits. Indian accounting standard emphasizes a realistic assessment to ensure financial statements mirror true asset worth. With an estimated residual value of $500,000, we refine our depreciation calculations further. Calculating depreciation requires selecting a method that reflects how the asset is consumed. Meridian Corporation uses straight-line depreciation for the $10 million SaaS asset, adjusted for a $500,000 residual value, resulting in $3.17 million annually. Choosing the wrong method can distort performance metrics. Indian accounting standard mandates consistency, ensuring the method aligns with asset usage. With this clarity, Meridian Corporation's financials reflect true asset depreciation across the 3-year term. Reviewing for impairment ensures the asset's carrying amount doesn't exceed its recoverable value. Meridian Corporation must regularly assess its SaaS contract for signs of impairment, adjusting if necessary. Ignoring impairment risks, inflated asset values, misleading stakeholders. Indian accounting standard mandates annual reviews, safeguarding accuracy in financial reporting. With this diligence, Meridian Corporation maintains transparency and accountability, with the final carrying amount reflecting true asset value. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Indian Accounting Standard 16 offers options, but each comes with specific disclosure requirements to ensure transparency and comparability. Here's how these choices influence financial reporting and decision-making. When recognizing an asset under Indian Accounting Standard 16, it's crucial to ensure that future economic benefits are probable and measurable. Initially, assets are recorded at cost, including all expenses necessary to bring them to their intended use. For example, a machine purchased for $100,000 with $5,000 in transport costs is recognized at $105,000. This approach ensures comprehensive asset valuation from the start. After initial recognition, Indian Accounting Standard 16 allows for either cost or revaluation methods. The cost model keeps assets at historical cost minus depreciation, while the revaluation model adjusts to fair value. Market fluctuations or asset condition changes might trigger revaluation. If a building originally valued at $2 million is revalued at $2.5 million, the $500,000 surplus goes to other comprehensive income, not profit and loss, highlighting the impact of these choices on financial statements. Indian Accounting Standard 16 requires assets to be presented as property, plant, and equipment on the balance sheet. emphasizing their revenue-generating purpose. Depreciation reduces earnings on the income statement, highlighting asset cost allocation over time. Detailed notes on measurement and depreciation methods improve transparency, aiding analysts in understanding company strategies and asset management. For instance, a $1 million equipment depreciating over 10 years directly impacts both balance sheet and profit and loss. Key disclosures under Indian Accounting Standard 16 include the measurement basis for each PPE class, offering insights into valuation logic. Depreciation methods and rates clarify cost allocation over asset life, crucial for understanding financial performance. Disclose impairment losses and reversals, as they directly impact asset values and investor decisions. For example, a $200,000 impairment on machinery can signal operational issues. Revaluation details, including frequency and methodology, ensure stakeholders appreciate asset value adjustments rationale. Imagine a CFO managing a $5 million asset purchase. The choice between cost and revaluation models determines how the asset influences balance sheet and earnings. Setting a 10-year depreciation life impacts tax and earnings forecasts. Regular market revaluation might adjust asset value, affecting financial ratios. By ensuring detailed disclosures, the CFO maintains transparency and investor confidence. This strategic handling aligns financial reporting with broader business objectives, demonstrating the dynamic role of measurement in financial management. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out, from initial recognition to period-end adjustments. Discover how Indian Accounting Standard 16 transforms lease accounting, affecting balance sheets and income statements with precision. The right-of-use asset and lease liability are recognized at the lease's commencement date. This entry ensures that both asset and liability are equally recognized at the present value of lease payments. Meridian's balance sheet now visibly reflects the commitment, aligning with Indian Accounting Standard 16's objective of transparent lease accounting. A portion of the lease liability is settled with each payment. The cash outflow reduces Meridian's lease liability, reflecting its reduced future obligation. This treatment maintains a balance between the asset's usage and liability reduction, providing a clearer financial picture. Depreciation systematically allocates the asset's cost over its useful life. For Meridian, this annual $120,000 depreciation aligns with lease terms, reducing the asset's book value. Such treatment ensures the income statement reflects the cost of using the leased asset. Interest expense on the lease liability represents the cost of financing the lease over time. By adding this charge, Meridian Corporation acknowledges the time value of money, offering stakeholders a complete view of lease-related financial commitments. Adjusting the balances ensures accurate reflection of the lease liability and right-of-use asset at year-end. This entry aligns financial records with actual lease status, enhancing transparency and adhering to Indian Accounting Standard 16 requirements, providing stakeholders with reliable financial insights. Modifications in lease agreements necessitate recalculations of both the asset and liability. By adjusting these balances, Meridian Corporation aligns its financial records with the updated lease terms, ensuring continued compliance and transparency under Indian Accounting Standard 16. Remeasurement of the lease liability due to interest rate fluctuations ensures financial statements accurately portray the lease's economic impact. For Meridian, such adjustments protect against misstatements, maintaining financial integrity and alignment with Indian Accounting Standard 16's principles. Recognizing the right-of-use asset and lease liability upon termination finalizes the lease's lifecycle and financial records. This closure aligns with Indian Accounting Standard 16, removing the asset and liability from the balance sheet, indicating the lease's conclusion and reflecting a clear financial position. Every Big Four and investment bank interview on Indian Accounting Standard 16 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. Indian Accounting Standard 16 covers the accounting for property, plant, and equipment, PPE. It excludes assets held for sale and investment properties. The standard ensures accurate asset valuation and depreciation. Common mistakes include confusing PPE with investment property. Remember, PPE is core to operations, while investment property is held for rental income or capital appreciation. Mastering this distinction helps in understanding asset classification. Indian Accounting Standard 16 was introduced to standardize the accounting for tangible assets like buildings and machinery. It ensures consistent valuation and depreciation methods. A key purpose is offering clarity on asset life and financial impact. Many overlook this standard's role in providing comparability across industries. Always link this to improved transparency and investor confidence. When a company revalues an asset, the increase is credited to revaluation surplus, a component of equity. If there's a previous decrease, reverse it first in profit or loss. Watch out for skipping revaluation surplus entry. This ensures all asset revaluations reflect true market conditions, impacting both the balance sheet and equity. Impairment loss is recognized immediately in profit or loss, decreasing the asset's carrying amount. Reversal of impairment is possible when conditions change. Avoid the pitfall of missing impairment assessments. Regular reviews are crucial. This ensures asset values on the balance sheet aren't overstated, maintaining financial statement accuracy and reliability. Depreciation under Indian Accounting Standard 16 and International Financial Reporting Standards is similar, but Indian Accounting Standard provides more detailed guidance on component accounting. Each part of an asset with a significant cost is depreciated separately. Missing this detail can lead to incorrect asset valuations. Master component accounting to align depreciation schedules with actual asset usage. Indian Accounting Standard 16 allows revaluation of assets at fair value, similar to international financial reporting standards. However, Indian regulators sometimes impose additional disclosures, ensuring transparency. Overlooking these can lead to compliance issues. Knowing local regulatory nuances is key for a smooth financial reporting process. Stay updated on both frameworks for seamless asset valuation. Calculate annual depreciation, then prorate for the partial year. If an asset costs 1,000 rupees with a 10% depreciation rate, for 6 months, it's 50,000 rupees. Avoid the error of ignoring the acquisition date. Accurate proration ensures expenses match asset usage timing, maintaining financial statement integrity. Practice prorating examples for fluency. Estimate residual value based on expected future economic benefits at the asset's end of life. Regularly review and adjust if conditions change. Common pitfalls include neglecting regular updates. Accurate estimates ensure depreciation aligns with future cash flow expectations. This precision impacts both asset valuation and depreciation schedules significantly. Asset impairments require regular assessment of recoverable amount versus carrying amount. A common mistake is neglecting interim checks between annual reviews. This oversight can lead to overstated assets, skewing financial results. Regular checks ensure assets reflect current conditions, safeguarding against unexpected financial impacts. Prioritize this to maintain statement accuracy. Disclosures must include useful lives, depreciation methods, gross carrying amount, and reconciliation of carrying amount. These elements provide transparency in asset management. The common trap is insufficient detail, leading to misinterpretation. Accurate disclosure supports investor decisions and compliance. Remember, the clarity of disclosures directly influences financial statement reliability and user trust. Indian Accounting Standard 16 is all about transparency in reporting tangible fixed assets. It ensures property, plant, and equipment are accurately reflected in financials. Covering all tangible PPE, it defines key terms like depreciable amount and residual value. Depreciation is critical, as it systematically allocates cost over useful life. Don't forget to review assets for impairment regularly. Significant parts should be componentized for precise depreciation. These fundamentals are crucial for any finance professional. Understanding the core models and measurements is essential in applying Indian Accounting Standard 16 effectively. The cost model involves carrying assets at cost minus accumulated depreciation and impairment losses. Alternatively, the revaluation model uses fair value adjustments. Initial measurement includes all necessary costs, while subsequent costs are capitalized if they bring future benefits. Regularly review useful life and revise depreciation methods. Derecognition occurs on disposal, impacting profit or loss through recognized gains or losses. For interviews, mastering Indian Accounting Standard 16 nuances sets you apart. Know the component approach requires separate depreciation for parts with different lives. Revaluations should align closely with fair value. Understand choosing between cost and revaluation models impacts financial strategy. Regular impairment reviews are crucial. Disclose depreciation and revaluation details meticulously. Recognize how Indian accounting standard differs from international financial reporting standards, such as the emphasis on componentization. Be ready for fair value assessment challenges needing expert judgment. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.